Stop. Before you even think about filing your taxes this year, there's something critical you need to know. The IRS just dropped new filing rules that could cost you thousands if you're not prepared, and most people have absolutely no idea these changes are coming. Listen, I've been analyzing tax law for years, and what I'm seeing right now is unprecedented. These aren't just minor tweaks to the tax code. We're talking about major changes to reporting requirements, updated income thresholds, and new penalties that could hit your wallet hard if you file the wrong way. And here's the scary part. Your tax software might not even catch these issues. Whether you're filing as a single person, claiming dependents, running a side hustle, or managing investments, these new rules affect you directly. I'm talking about changes to deductions you've relied on for years, new documentation requirements that could trigger audits, and completely different filing deadlines for certain tax situations. The worst part? The IRS isn't exactly sending out personal notifications about this stuff. You're expected to just know. But don't worry, I've done the heavy lifting for you. In the next few minutes, I'm breaking down exactly what's changed, who's affected, and, most importantly, what you need to do right now to protect yourself. But first, if this video is already saving you from a tax nightmare, smash that like button. It helps more people avoid these costly mistakes. All right, so let's dive right into this because time is not on your side here. Tax season has officially begun, and if you're sitting there thinking you can just file the same way you did last year, you're setting yourself up for some serious problems. The IRS has implemented changes that are going to affect nearly every single taxpayer in America, and I'm not exaggerating when I say that ignorance of these rules could cost you anywhere from a few hundred to several $1,000s. So grab a coffee, settle in, and let me walk you through everything you absolutely need to know before you hit that submit button on your tax return. First things first, let's talk about the biggest change that's going to impact the most people, and that's the new reporting requirements for third-party payment platforms. Now, you might be thinking this doesn't apply to you, but hold on a second. If you've sold anything on eBay, Etsy, Facebook Marketplace, or if you've received payments through Venmo, PayPal, Cash App, or any similar platform, you need to pay very close attention. The IRS has dramatically lowered the reporting threshold, and this is massive. In previous years, these payment platforms only had to report your transactions to the IRS if you had more than 200 transactions and earned more than $20,000. That was a pretty high bar, so most casual sellers never had to worry about it. But now, and this is the part that's catching people completely off guard, that threshold has been reduced significantly. We're now looking at a situation where if you receive over $600 in payments for goods or services through these platforms, you're going to receive a 1099-K form, and the IRS is going to receive a copy too. Now, why does this matter so much? Because suddenly, that side hustle where you've been selling vintage clothes online, or those freelance graphic design gigs you've been doing through PayPal, or even that old furniture you sold on Facebook Marketplace, all of that is now being reported directly to the IRS. And here's where people are going to run into trouble. The IRS is going to see that you received, let's say, $5,000 through PayPal last year. If you don't report that income on your tax return, their computers are going to flag the discrepancy immediately. You're going to get a letter, you might face an audit, and you're definitely going to owe back taxes, plus interest and potentially penalties. This is not a maybe situation. This is absolutely going to happen if there's a mismatch between what the payment platforms report and what you claim on your return. But here's the nuance that's really important to understand, and this is where a lot of people are going to make mistakes. Not all money you receive is actually taxable income. If you sold your used couch for $300, that's not income because you sold it for less than what you originally paid for it. That's a personal item sold at a loss. The problem is, the 1099-K form doesn't know that. It just shows that you received money. So you need to be prepared to document and explain these transactions. You need to keep records of what you sold, what you originally paid for it, and be ready to show that you didn't actually make a profit. This is going to require a lot more organization and record keeping than most people are used to, and if you're not prepared for it, you're going to have a really frustrating time trying to sort it out after the fact. Moving on to another major change that's flying under the radar for a lot of people, and that's the modifications to the standard deduction and how it interacts with certain credits. The standard deduction has been adjusted for inflation, which is good news on the surface. For single filers, we're looking at a standard deduction of about $14,600, and for married couples filing jointly, it's around $29,200. These numbers go up slightly each year, but here's what people don't realize. Just because the standard deduction went up doesn't automatically mean you're going to owe less in taxes or get a bigger refund. Your tax brackets have also been adjusted, and depending on your specific situation, you might actually end up in a different position than you expect. What's really important this year is understanding whether you should be taking the standard deduction or whether you should be itemizing. Now, I know itemizing sounds complicated, and most people just automatically take the standard deduction because it's easier. But with some of the changes we've seen in deductible expenses, especially related to home offices, medical expenses, and charitable contributions, it's worth actually doing the math this year. The IRS has tightened up the rules around what qualifies as a legitimate home office deduction, especially for people who are employees working from home. If you're a W-2 employee and your employer had you working remotely, you cannot deduct your home office expenses anymore. That's been the rule for a few years now, but people keep trying to claim it, and then they get denied, or worse, they get audited. The home office deduction is now really only available for self-employed individuals and independent contractors, and even then, the IRS is scrutinizing these claims much more carefully than they used to. Let's talk about something that's affecting families in a big way, and that's the changes to dependent-related credits and how they're being verified. The child tax credit has returned to its pre-pandemic levels, which means for many families, you're going to see less money than you got in those pandemic years. The credit is back to $2,000 per qualifying child under the age of 17, with up to $1,600 of that being refundable. But here's where the IRS is cracking down hard. They want absolute proof that the children you're claiming actually qualify as your dependents. This means you need to have Social Security numbers for all your dependents, and those Social Security numbers need to be issued before the due date of your tax return. You also need to be able to prove that the child lived with you for more than half the year and that you provided more than half of their financial support. I'm bringing this up because there's been a huge increase in fraudulent dependent claims, and the IRS is using sophisticated algorithms to catch discrepancies. If you're divorced or separated and you have a custody arrangement, you need to make absolutely certain that you and your ex-spouse aren't both trying to claim the same child. Only one of you can claim the dependent exemption and the related credits, and if you both try to do it, both of your returns are going to be flagged and delayed while the IRS sorts it out. This can hold up your refund for months, and it creates a massive headache that's completely avoidable if you just communicate and agree on who's claiming the kids before you file. Another area where the IRS is tightening enforcement is around cryptocurrency transactions. If you bought, sold, traded, or earned any cryptocurrency last year, you need to report it. Period. The IRS has made it crystal clear that they consider cryptocurrency to be property, not currency, which means every single transaction is potentially a taxable event. If you bought Bitcoin at $30,000 and sold it at $40,000, you have a capital gain of $10,000 that you need to report. If you traded Ethereum for some other cryptocurrency, that's also a taxable event because you're essentially selling one asset and buying another. Even if you never converted your crypto back to regular dollars, you still have to report these transactions. What's really catching people off guard is that the IRS now requires you to answer a question about cryptocurrency right at the top of your tax return. It literally asks if at any time during the year you received, sold, sent, exchanged, or otherwise acquired any financial interest in virtual currency. You have to check yes or no. And here's the thing. If you check no when you actually did have crypto transactions, you're not just making a mistake, you're potentially committing perjury because you're signing your return under penalty of perjury. The IRS is getting transaction data from major cryptocurrency exchanges, so they know if you had activity. If you lie on that question and they find out, you're looking at penalties that go way beyond just paying the taxes you owed. We're talking about fraud penalties that can be up to 75% of the underpayment, plus potential criminal charges in severe cases. Now let's shift gears and talk about something that affects anyone who's been working in the gig economy or has received income from non-traditional sources. If you drove for Uber or Lyft, delivered food for DoorDash or Grubhub, rented out a property on Airbnb, or did any kind of freelance or contract work, you need to understand that you're essentially running a small business in the eyes of the IRS. This means you're responsible for paying self-employment tax on top of your regular income tax. A lot of people don't realize this until they sit down to file and they discover they owe way more than they expected. Self-employment tax is about 15.3% of your net earnings, and it covers your Social Security and Medicare taxes that would normally be withheld from a regular paycheck. The good news is that as a self-employed person or independent contractor, you can deduct your business expenses to reduce your taxable income. This includes things like mileage if you're driving for rideshare or delivery services, supplies you had to purchase, fees you paid to the platforms, and even a portion of your phone bill if you use your phone for business. But, and this is crucial, you need to have documentation for all of these expenses. The IRS is not going to just take your word for it. You need receipts. You need mileage logs. You need records that prove these were legitimate business expenses. One of the biggest mistakes I see people make is trying to claim deductions without any documentation, and then when they get audited, they can't prove anything and they end up owing back taxes plus penalties and interest. Here's something else that's really important for anyone who received unemployment benefits, pandemic relief payments, or any kind of government assistance last year. Some of these payments are taxable and some aren't, and you need to know the difference. Regular unemployment compensation is absolutely taxable at the federal level. If you received unemployment, you should have gotten a 1099-G form showing how much you received, and you need to report that as income. Some states automatically withhold taxes from unemployment benefits, but many don't, which means people get a nasty surprise when they realize they owe taxes on that money. If you didn't have taxes withheld from your unemployment, you need to be prepared to pay them now. As we're getting close to wrapping this up, I want to make sure you understand the critical deadlines you're working with. The standard tax filing deadline is April 15th, and that's a hard deadline unless you file for an extension. But here's what people don't understand about extensions. Filing an extension gives you more time to file your return, but it does not give you more time to pay any taxes you owe. If you think you're going to owe money, you need to estimate what you owe and pay it by April 15th, even if you're filing your actual return later. If you don't pay by the deadline, you're going to start accruing interest and penalties on the unpaid balance, and those add up fast. The absolute worst thing you can do is just not file at all because you're scared or overwhelmed or you think you can't afford to pay what you owe. Not filing is so much worse than filing and not being able to pay immediately. If you file your return and you owe money but can't pay it all at once, the IRS actually has payment plan options available. You can set up an installment agreement where you pay off your tax debt over time. The IRS would much rather work with you on a payment plan than chase you down for not filing at all. When you don't file, the penalties are severe. You lose your refund if you have one coming, and you create legal problems for yourself that can snowball into wage garnishment, bank levies, and tax liens. So here's what you need to do right now, today, before you do anything else. Gather all your tax documents. I'm talking about your W-2 forms from your employers, all those 1099 forms for any other income you received, documentation of any deductions you plan to claim, records of estimated tax payments you might have made throughout the year, and information about any major life changes like getting married, having a baby, buying a house, or starting a business. Once you have everything together, either sit down with tax software that you trust or seriously consider hiring a tax professional this year, because these changes are complex and the cost of making a mistake could be way more than what you'd pay for professional help.